All right. Good afternoon, everybody. It's the weekly chat with Chris. It's 4:30. If you know me, I like to start on time, be punctual. Appreciate you guys taking time out of your day to hop on a call with us and to learn a little bit more about what's going on in the world, finances, things in general. So hope everybody's doing well. I'm going to go ahead and get right into it. To Roth or not? That is the question. This is a picture of Senator William Roth. Before he passed away, he was the architect and he was an attorney that drafted the documents to put into effect the Roth. And, Roth IRAs actually were created back in 1998. And a lot of people didn't really understand them for a while there. It took a while to take hold. And back then, IRA contributions were, $1,500, $2,000, and didn't seem like you could do a lot with them. So they didn't get a lot of attention. And then in 2006, 401k started to adopt the ability to. It's now only 15 years later where it tends to be a little bit more mainstream. But I do find that a lot of people still don't quite understand how they work. And before we understand, why should we consider a Roth, now as we approach retirement, or maybe we're in retirement, what are the pros and cons? Well, here's the ultimate question. Do you think taxes in this country will be lower, the same, or higher? And I'm referring to income taxes. So depending on how you answer that question, I'm now going to present to you a slide that is very busy. There's a lot here. If you've never seen it before, you're going to go, oh my God, what is this? Well, this is the usdebtclock.org. You can go to that URL and actually see it real time. And you'll see in the upper left-hand corner is our US national debt. It is in excess of $28 trillion. Now, what I find so interesting and so amazing to me is when I was first introduced to this debt clock, it was back in like 2005, 2006. And it was something like between $5 and $8 trillion then. Fast forward 15 years to 2021, and we're $28 trillion. That's US national debt. This is US total debt. This is all Americans, $86 trillion. It's an unfathomable number. And this doesn't even include some of the proposed new tax spending or relief spending by the current administration. So when we look at these numbers, we go, oh my God, this is a lot of money. But let's look at how much are we collecting as a country. Well, we're only collecting on an annual basis $3 trillion in tax revenue. You don't have to be a math major to understand that this country has a spending problem. And if we ran our households like the government is currently running, the national debt, kicking the can down the road, we're going to find out in a hurry that taxes are probably going to be higher in the future. They have no choice. So where's a logical place to go to? Well, let's talk about the places where we've been putting our money. Right? As Americans, we were all told, let's put our money into IRAs, tax deferred vehicles, 401ks, 403bs, TSPs. Well, is that really the best advice now? Right? And most accountants or most CPAs will tell you, okay, we want to lower our taxes this year. Well, you know what? If we're putting money into a tax deferred vehicle where it's going to be taxed higher later, that probably doesn't make a lot of sense. Now, this is a dummy account. I've changed the names of the innocent and the account values to help illustrate this because of confidentiality. But I want you to see the highlighted. This client came to me. It was referred by another advisor, and their mother passed. And so they inherited an IRA, and, as they're 53 right now. And so, they had $300,000 in this inherited IRA, and, the mother just passed, and we've lost, because of the Secure Act, we've lost the ability to do stretch IRAs. So you're going to see here that the rules have changed. And I point this out because what I tried to show these folks was, look, what's going to happen? And over time, we looked at how they're currently positioned. If they lived a life expectancy, that it's not how much money do you end up with. It's what is the possibility of our tax payments along the way. And they're looking to basically spend $5 million in taxes over their lifetime if they live the life expectancy. I just start to question the wisdom and the advice that we've been given in the past, because again, the tax environments back then are not necessarily where we're headed in the future. So I've shown this calculator before, so I've taken all the click-throughs in the spirit of time through, but each slide is going to take us through one conversation. If we look up here, right, these are three colored horses. We have taxed annually, tax postponed, or tax advantage, right? So tax annually is the blue horse. Tax postponed means like your 401k, IRA, 403b, or tax advantage, tax free, if we can get that. So what this basically says is, hey, if we apply math and we just contribute equally to each of the three environments, the tax environments, and we give it the same crediting rate, we give it the same time frame to bake, the accumulation phase, we take this money out at the same amount over, $67,275, and we tax it the same on the way in and tax it on the same on the way out. Who wins the race? Well, it's a complete tie between tax deferred and tax free or tax favored. The loser here is tax annually. And if you've not seen my presentation on the horse race in the past, I have a copy of that video on the horse race. I'm not going to take us through that right now. With that, taxes stay the same. It's a tie. Now, if the advice that we've gotten along the way, and maybe you're one of those folks where this applies to, right? If during the accumulation phase, we were actually in a higher tax bracket, and that's the only difference here, then tax deferred, if we're actually in a lower tax bracket when we retire, then tax deferred or tax postponed won this race. But if you're one of those people that in the audience that raise your hand that you think taxes are going to be higher in the future, so let's say that it was taxed, during your working years, right, you were actually paying lower taxes than in the distribution years, well, then tax-free wins. So if that's the case, let's take a closer look, because you guys on this call might recognize this gentleman, arguably one of the smartest men to ever live. And he's quoted as saying that the hardest thing in the world to understand is the income tax. So part of what I felt it's compelling to go over first, we have to understand it at its core. So this graduated cylinder that I have here, the cylinder on the left is what our tax environment was in 2017. And this is before the TCJA, or the Tax Cut and Jobs Act, that went into effect. On the right side is our current tax environment. So the thresholds, remember, we live in a marginal tax bracket environment. So not every dollar is taxed at the same rate. Once you reach the threshold, you go from 10 to 12, 12 to 22, 22 to 24, and right on up. But that red arrow in the upper right-hand corner is a date that is a current law right now. It says on the end of that date, 12/31/2025, that the cylinder on the right is going to revert back to the cylinder on the left, bar any administration changes. And there's current talk of that happening right now. So I'm just saying this is what's already law. So the government is absolutely, like I said, is addicted to spending, trying to bail everybody out, worry about paying the piper later. But depending on the environments that we have our money saved in right now, we have to be very conscientious of what could happen. So here is, an example of this client's roughly their income. It was an estimate. And because the tax environment is, people get the deer in the headlight look. They look and they go, taxes are confusing. It really doesn't have to be. Both couples were under age 65. Their combined income in this example, $259,000. And then we all get, because they've done away with all of our, itemized or, personal exemptions, right? We have a standard deduction right now. $24,800 is the current 2020 deduction. And then now you just subtract, and this is the taxable income. You see, that puts us at a marginal tax bracket of 24%. The reason that's relevant is because how much higher or how much more income could this example take without pushing us into the next tax bracket? And that amount is $92,400. And that's an important number to know when working and strategizing on how to disarm or unravel, our 401ks, IRAs, in this case, an inherited IRA, right? Can we start to take distributions and start to disarm this ticking time bomb? So now what I do is I say, okay, let's look at this client's income. 234,200 puts them at the 24% marginal. And on 1/1/2026, they're going to immediately go to 33%. That's already a given. And they were shocked, right? Because it's not what I can tell you, it's not what their mother planned when they put the money into the IRA in the first place. Okay. But they will go from 24 to 33% overnight. But the other hidden secret or the dirty secret that a lot of people either don't consider, don't think about, because it is an unpleasant topic, is what happens when one of them passes. Well, you know what? Our tax brackets on the left side, we're really, really in trouble now. So you can see that we're at least at 33%. And that's bar any tax rate rises in the future. So a lot of folks have never heard of this gentleman. New Jersey 101.5 is a popular radio station here in New Jersey. And they used to conduct a road to financial success. And back in 2005, 2006, 2007, I was doing these presentations and I would play his video. Now, David Walker was the head of the government accounting office. He sat on the board of Social Security Board, CPA Hall of Fame. He basically is the United States #1 CPA. He's been the comptroller general on both sides of the aisle, right? Regardless of the administration. And what he's quoted as saying is, regardless of what politicians tell you, any additional accumulations of debt are absent dramatic reductions in the size and role of government, basically deferred tax increases. Unless we get our fiscal house in order, there's simply no way to handle the ever mounting debt except by doubling. Let me repeat that. Doubling taxes over time. And I had one client that I shared this with, and they said, impossible. There would be a revolt in this country if they doubled taxes. Taxes could never go that high. Oh, really? Well, let's do a little history. So if we look at this chart here, and there's a lot going on, but I just want you to see a couple points. The first thing is, what year did this start? And that's 1913. 1913 is the year that our income tax first went into effect. And it was designed to be a temporary tax. Now, fast forward 100 years, and that temporary tax is still in effect. I also want to point out to you is that there's a green line in the middle. The green line in the middle has been the average tax bracket of this country since inception, 57%. I also want to point out to you that in this hypothetical account, a lot of people view, okay, if I have $1 million in my IRA, right? Oops, I went ahead. If I have $1 million in my IRA, right, that all that money is yours. And I will quite often ask folks, how much of that money is yours? And they'll go, all of it. I go, really? And I go, well, there's an unpaid lien on that account, an unpaid liability on that account. And that's called taxes. Oh, yeah. Well, what are the taxes due? And the answer is we don't know, because it depends on the taxes at the time that we withdraw. Now, one of the things I point out here, and a lot of folks don't know this, but our taxes in this country used to be as high as 94%. Think about that, 94%. Right? Now, there was an actor that used to do 2 movies a year, and he was paid $100,000 a year back then. And he stopped doing any movies after he did those 2 movies, because the threshold was any income that you earned over 200,000 was taxed at 94%. And when asked why he only did 2 movies, he said, because any income that I earned after that $200,000, and because he lived in California, not only did he have to pay the federal tax, the state tax, he was basically, it made no sense for him to work. So that actor's name was Ronald Reagan. right? So it's just a little bit of tidbit, but I think it's important for us to know when somebody says that when you look at our tax environment right now, we're actually in a pretty low tax environment. So we have the opportunity to start to disarm or unravel, or like I like to express, divorce the IRS. Let's go ahead and start to explore options to start to either stop contributing to these ticking time bombs, start to fund other options so that we can have a well-rounded plan as we approach retirement. Now, in this example, 24% of it, well, there's a lien on that account. 24%, if everything stayed the same, then $240,000 is owed to the IRS, regardless of the year that you take it out. But on 1/1 of 2026, that is automatically going to 33%. So they've just taken a haircut overnight by just because that's already law. And a lot of folks don't even realize that. But if David Walker's right and now they double it, well, now you're just above the means, right? Remember, things tend to gravitate back towards their means, and it may be too late in the future for us to figure out how to disarm this later, or they change the rules that prohibit us from doing that, and now we're all sitting around, and then there very well could be a revolt. So this publication 590B, the reason I put this here is because in a shocking interpretation of publication 590B. So remember that we used to have stretch IRAs that basically if we passed, we owned qualified money, we had an IRA, 401k, we could turn around and name our beneficiaries, usually our children, right? If it's spouse, it's one set of rules. If it's children, it's another set of rules. But the children could then stretch it over their lifetime. So it could go on and on and on and on. And then they changed that, right? So in the Secure Act a couple years ago, right, we all interpreted, they said that that account had to be paid out over 10 years. But it could be right, let's say that you were 55 and you didn't need the money in 10 years, you could take it out 10 years. Well, the interpretation that came out last month is that the IRS is now saying, no, we want that to start to get paid out now and over the next 10 years. Now, that is not finalized yet, but that looks likely, and that's why Ed Slott wrote this piece. Ed Slott is now like basically the country's top IRA and tax deferred vehicle expert. So it's just a very insightful piece that things are changing, and that's what got this client's attention, that we are starting to disarm or accelerate the distribution of this inherited IRA to help preserve and to help provide tax-free income into retirement. And those are conversations that we can have in the future, and you'll see. So Roth or Roth-like options. So let's just, that's the purpose of today's topic. And again, because of time, I'm just going to go at a little bit of accelerated pace. But I had to make sure that everybody understands what's the problem so that we start to think about, okay, I have to explore solutions. Well, the first thing is Roth IRA, right? The problem is income limits, right? So we're only able to put or contribute in based on our age and based on our income and whether we're single, married, filing jointly. In lack of a better explanation, the government will start to discriminate against people that earn above certain income levels, right? So Roth 401ks, there's no income limits. Like I said, 5 years ago, I could ask 100 people that came through my office, and 75 of them would say, no, my plan does not have a Roth 401k option. Now I'd say it's about 50-50. A lot of plans are now adopting or amending their plan documents to allow it. And so it's more common. And that's one of the easiest things we can do is we can just, if we're already putting money aside for our retirement, the only thing that you have to be aware of is when we put our money into the Roth 401k environment at work and we're getting a match, anything that we put in can go into the Roth environment, so it grows and defers tax-free. But anything that the company matches must stay in that tax-deferred arena. So if you're getting a dollar-to-dollar match, 6%, the 6% that they give you will be tax deferred like we talked about, but the 6% or anything above up to the limits will be tax free going forward. Roth 403Bs, same thing. So 403Bs are typically for nonprofits or universities or charitable organizations, things of that nature. Roth conversions. This is where I can be a great help. You got to weigh the pros and cons. Not everything's automatic. I did a presentation 3 years ago, and a person was sitting in the audience, and they were so excited to hear about this content that they came into my office and they go, I want to do a Roth conversion. I want to move it all $300,000 into a Roth today. And I was like, time out. That's typically not prudent. That's why I showed that slide where it says, where are we at? Where, how much room until we get to the next bracket so that we're not taking it on the chin. We have to do this in piecemeal. That's what I call tax bracket management, and hoping to help folks figure out how much additional income we can take and not have those dollars taxed or exposed to a higher tax bracket. And then this is IRC 7702. That's Internal Revenue Code 7702. There's no limits on. They work just like a Roth without the market risk. And we're going to actually talk about an idea or a concept next week. I'm going to start to dive into a strategy that I refer to as Kaizen. And I think that that's on the schedule for next week, which we'll start to talk about the details. But it is max funded, properly structured cash value life insurance is probably one of the greatest gifts Congress has ever given the American taxpayer, but it has to be properly structured. So the number one question when doing Roths or Roth conversions or any of that stuff, where does money come from? And the answer is, I don't know. We have to look at that. I mean, the income limitations went off the radar back in 2010. And this is a conversation I used to have with folks. Just because the government says you can do it doesn't mean that we should do it. Not if we don't have the money. You never want to typically go into the account and raid the account to pay the taxes. So we have to find the account and have the discretionary income elsewhere to be able to do that. So that's why I wanted to have this conversation today, because we're coming up on May 17th, right? That's been the extension. It's too late to do the Roth contributions for last year. However, there's also things that we can talk about called backdoor Roth IRAs, backdoor Roth conversions, mega Roth. There's a couple things in strategies. If you have questions around this area, run them by me. If I don't know the answer, we can call the plan that you're currently in, find out what their rules, and strategize longer term to create this portion of your portfolio that is tax-free as we go forward. The last thing that was a disclosure. Let me just make sure I don't go too quickly. Yeah, I think I put the slides out of order, so I apologize. But the first thing is, to my mom, I want to wish happy Mother's Day. To all of you that are mothers on this call, I want to wish you happy Mother's Day. To those of you that are married to a mother, or your mothers are still around, make sure that you reach out to them and give them hugs, and they put up with us, right? And then if your mom has since passed, right, our prayers. But you know what? Moms are what make the world go round, and they need and deserve the attention we give them. The other thing I wanted to share is I'm a member of the Rotary up in Bridgewater, Somerville Bridgewater Rotary, and every year they've been doing a lottery, $20 raffle ticket if you want to do it, 3 grand prizes, 16 grand. If you're interested in that, send me an email, or Caitlin, Professional Planning Services. She's got all the details. She can help you out. So I want to thank everybody for taking time out. We're right at the hour. Like I said, I know I went at a very accelerated pace, but this is something that's close and dear to my heart. I just believe that this country, it's the greatest country on the planet, but we got to make sure that we keep things in check and preserving everything that we built so that it just doesn't evaporate because rules changed and nobody told us. So at least you now know, hey, listen, there are options that you should be exploring, and we can design things that'll help you. So without further ado, folks, happy Mother's Day to all the mothers out there. Have a great weekend, and I'll talk to you soon. Thanks for joining us. Bye-bye.